And welcome to another episode of our podcast, Sweatin Money, or Hung Qin Hon. I'm your host, Kong, along with my co-host, Gibson.
Wonderful introduction as always.
Yes, thank you. Look, so we've seen the markets. It pretty much bottomed out, Monday, and then it came back up a bit and kind of like went and did its thing, going up and down again. And as of Friday, it was down 11 points from what it was Thursday. So what do you think accounts for some of these volatile actions here, Gibson?
Well, there's a lot of question about confidence, question about growth, just the future. Stock price is reflection of what everyone thinks about the future, and in essence is that if we believe the economy is going to keep growing, then the stock price is going to keep climbing. If we believe, it's kind of like if we continue to believe that the stock values will keep going up, then it'll keep going up. But the minute we start thinking, hey, it might stop growing or might start coming down altogether, no one wants to be part of that. So oftentimes these sort of dips will lead into like a panic sale of sorts.
Yeah. So, what do you think is worrying the market? Why do people think it might not be doing as good as it should?
Well, there's a lot of concerns. There's the Eurozone, the issue with Greece and Eurozone. There's the issue with Iran. There's also the issue of China. And then there's always the Fed rate hike. There's a multitude of factors, but I believe one of the primary factors would be China. If you were to look at the news and the market and what's been happening for the past few months, nothing has really impacted the market as greatly as China's currency devaluation.
Well, to go on with some with devaluation, China's going to lower their devaluation so that it can help their exports. But then because of that, America might try to do the same to weaken its dollars because it doesn't want its exports to be weakened. But then, of course, when that happens, Europe is also going to try to do the same thing. So when all three major economic regions start doing this, it's probably not going to be as effective as everyone thinks. So if that actually happens, what's going to be the next move beyond that?
Well, think about it this way. If everyone's going to get into a price war of sorts, like no stockholder really wants to be part of that. So I would imagine a lot of people might start selling their stock in response to this currency devaluation war. But the problem with the currency devaluation is that China's fixing their currency to United States dollar. So no matter how much we reduce our currency, their currency is always going to be lower.
Right. So there's the devaluation for both China and possibly the U.S. and maybe Europe eventually, but I think that's more speculation at this point. So aside from the devaluation issue, there's also the Fed rate hike that you had just mentioned. So do you think it's actually going to happen?
Well, there's many factors. I think initially there's a lot of people say the Feds will not take it into account. Then they would say the Feds will take it into account, and now they're like, we're not too sure anymore. I think a lot of it has to do with confidence and the effect of the Chinese devaluation on our markets. What does that mean, right? In essence, is that China, when they unfixed their currency, was going to expose themselves more to market forces. So the RMB was going to climb up in value, which increases their purchasing power, which increases their imports and reduces their exports. And the problem with it right now is basically the entire world is waiting for China to start importing products because they've been exporting so much. So when they start importing, the entire world will start having a GDP growth because GDP is a factor of imports and exports.
So, okay. Well then, back to China for a bit. So, what do you think what do you think the central government's next step is going to be? Because I mean, well, what they had planned was back in July, they said, okay, any of the major sellers, you can't sell your shares, or at least if you're going to sell, you were going to limit your selling off to like X number of shares. And they even got the big several big companies or several big major fund companies to say, okay, we aren't going to sell our shares, to try to boost confidence in the Chinese economy. And that seems like it hasn't happened. They originally, the score was supposed to be, getting it back up to, what was the magic number again? 3,500. And then now, I mean, let me see here. That was about just, yeah. They wanted to get it back to like 4,000. and it hasn't happened. Then, like towards the end of August, it just dropped more. It's barely starting to come back up. Just as of the closing, it from the day prior, it came back up 148 points, which is about maybe 5%. And I mean, that's still pretty significant. But do you think the central government's meddling in the economy actually works, or do you think it actually makes things worse?
Well, I think a certain amount of regulations is necessary to avoid panic or unnecessary panic. The question is, I think in a way, I think the Chinese government's actions right now is really what's preventing a massive global sell-off. Is, basically Monday, everyone's just worried that, China doesn't know what they're doing, and basically the share price is going to fall, the government's going to be powerless to help. Actions by the government to attempt to address these issues have been ineffective. Once we allow the market force to take play, the value of the stocks is going to tank. And all this panic is what's causing a lot of the prices to drop down. And, everyone's kind of interrelated. The market's really global now. So businesses and companies in America are also heavily intertwined with Chinese companies and European companies and so on. And this type of shock, the fear that, the stock prices can go down, access to liquidity is going to go down, just prompted a ton of sell-off. And this action by Chinese government is basically them saying that, what, we will do what it takes to ensure that there will not be a panic sell. They seem to signal that. And, the market right now is just holding the breath going, hey, is it going to work? Is it not? It seems to be working okay. I think part of it is a calming, reassuring effect right now that's really boosting the market. And, it's almost a period of time where people are thinking, maybe I overreacted. Maybe it's not so bad. And, the Chinese government intervention has introduced this possibility, which is why we're seeing the market stabilize a bit more and possibly some recovery in effect. Just because the United States started calming down, European markets started calming down, and the Chinese market also started to calm down as well. Because initially it was like a fear it's a panic sell. One person started panicking, another country started panicking, and everyone started panicking. So
right. With first with Greece, and then everyone's talking about China afterwards, and what next? Yeah.
Yeah. Because then we're all based on growth. So if all stock price growth is really based on future growth, and say, hey, you know what? We might buy the stock now, but like 5 years, 10 years from now, it might be worth twice as much, 4 times as much, who knows? But more than now, that's the whole thought process. You buy and hold in the long position. Are you always thinking the stock price can go up? But what causes the price to go up? The market value of it goes up. And what causes the market value to go up? The value of the company. Well, how does the value of the company go up? They do more business, they have more sales, they have more profits, they grow bigger. There's just more future potential, future earning potential associated with it, and that's why the prices kind of go up. Of course, there's other psychological factors as well.
Yeah. So with the market somewhat recovering, do you think these are signs that things are going good, or you think there's going to be another drop sometime soon?
I think it's possible for both. I think, like let's say the Reds hike there's going to be two factors that's going to cause the drop: the Fed's rate hike, and there's also actions by Chinese government and how the stock market fares for the coming week. I mean, these are going to be extremely volatile times for anyone in the market right now. Of course, good times is a time that you might lose money, and it's also a time that you might make a lot of money. But I think these coming months, it'll be a great time to keep your eyes on the market. And of course, towards the end of the year, a lot of people sell, and there's a lot of activity towards the end of the year because of Christmas, because they want to basically lock in their gains and losses for the year. So there's a lot more activity. But I think, you'll probably be watching the market until the end of the year.
Yeah. One of the other things that I think was going to come out was the jobs report, because I'm trying to go onto the Bureau of Labor Statistics website right now, and it says, we're sorry, the BLS website is temporarily unavailable. So either other people are trying to check for the jobs report to see if it came out or something. But I think that's also going to be another factor that people are going to look at to see whether or not the economy is actually growing or not. I think consumer confidence, however, that was still lower than it should be, I think.
Well, if the Feds are the actions by the Feds and what they've been signaling is any sign that of their actions and consumer confidence, I would say that consumer confidence is pretty high and the economy is basically where it should be. So right now the Fed is debating whether or not they need to take some gas out of the engine or I mean, they need to tap on the brakes a little bit, just slow the economy down, or just keep letting it run. And I think Ellen has always said that the stock market is not really part of the equation, not really a major contributor to the actions of the equation. But then the real problem, I think, is that the Fed's goal is to basically maximize GDP or keep GDP at a normal level and then control inflation. So with China devaluing the currency, we're going to basically import more instead of export more, or we're counting on China to help to buy products from the United States, so we export more. So that basically means that our GDP effectively have gone down thanks to the Chinese devaluation. So I think Ellen's going to have to take a lot of have to analyze the data a bit more to see whether or not it's going to have a real impact or not. But that's not, so one thing is true is that they're not really technically taking the stock market into account. They're taking the actions of the government globally into account. So they're thinking, hey, are they going to keep devaluing the currency? Because that's going to impact the economy for sure. Stock market is kind of like, oh, this is how they're loaning money and how they're regulating money and et cetera. They're not too concerned about that, but I'm pretty sure the actions by the Chinese government did give them due pause, at least for a little bit. And a lot of people before September rate hike almost a sure bet. And now they're thinking maybe it's going to push back a little bit more. And that is strictly introduced by the actions recently taken by China.
Okay, so let's see here. So I think that pretty much sums up the roller coaster ride for this week. Are there any specific stocks that you were looking at, or any recommendations?
Well, I kind of like the bank stocks, but I also don't like the bank stocks. Now, let's say this. If the Feds do hike the rates, which stocks would benefit the most? And I would think the bank stocks. I mean, every other company, technically, when the Feds hike the rates, there should be a withdrawal from the market on a global scale. And the reason why is now investors originally that were on the fence about the stock markets or just leave it into savings or some sort of like a deposit, they would just basically be in the market. But now, after we increase interest rates, now they might put it into a CD, they might like do a bond, etc. So then that's going to extract money out of the market. And when that money gets extracted out of the market, the price is going to drop just because demand dropped. That makes sense. But then the question is like, well, would people still want to be involved in the market? Like, what if where are the people going to go? And my thought process on it might be, well, maybe the banks. It might not be the banks. Who knows, right? No one can perfectly predict the future, but I would imagine that a lot of money might go into the banks. It might even go into foreign capital investments. But for now, I would keep my eye on it. Or, maybe people might take their money out and put it into like typical investments like businesses or, cause you have to understand that there's a few effects is that because we know that the rate hike is imminent, that gives a lot of people incentives to start their businesses now. Get the loans while it's cheap, get the mortgages while it's cheap, and that could spur a lot of activities.
Yeah, I mean, if you're business oriented, yeah, you would think that, but a lot of people they normally don't think like that. They think they don't think about starting their own business until like there's actually a lot of business activity going on. You see a lot of people doing good and all that. But yeah, no, that is a good idea. But anyways, so as far as tips and suggestions, I don't have anything for this week, nor do I have any specific stocks to look at. So I guess we'll just end it here. Just a reminder. We may or may not have ownership or other positions in the stocks that we mentioned or anything that we mentioned today. Don't buy stocks based solely off of what you hear from this podcast. And always do your own homework and research before buying and investing in stocks. Plus, just a reminder, this is just a podcast where we're tracking, we're tracking the economy because we're looking after our own investments. So, this is more of an experiment for us as much as it is for you guys. So if you guys have any tips out there, hey, let us know. Anything to add to that?
Not really. I think you covered pretty well. Although I do have to add that instead of buying a stock in a highly volatile time that could go up or down, it doesn't hurt to just hold on to cash.
Okay, there's that. All right, so where can people reach you at, Gibson?
They can reach you wherever this podcast is found. Just leave a comment. Encouraging us to give you a form of way of reaching us, and we'll get on that. Okay, so just to let you guys know, we do upload this onto YouTube
You can also reach us at our website. That's MNY, as in money, .conqueringpath.com. That's CONGKERINGPATH.com. All right, so that's it. Thanks.